Today, I want to give you one number, just one, that separates investors from gamblers. It is called PE ratio. And by the end of the video, you will never look at the stock the same way. PE stands for price to earnings. Let me make this very simple. Imagine your friend owns a small chai shop. It earns 1 lakh profit every year. You want to buy that shop. How much will you pay for it? If you pay 10 lakhs, you're paying 10 times the earnings. That is a PE of 10. If you pay 50 lakhs for the same shop, PE is 50. Same shop, same profit, but you paid 5 times more. That is expensive. Now, replace the chai shop with Tata Motors, Infosys, or Zomato. The formula is exactly the same. PE equals share price divided by earnings per share. The higher the PE, the more you are paying for each rupee of profit the company makes. Here is where it gets uncomfortable. Historically, the Nifty 50 trades at a PE of around 20 to 22. That is a fair price for India's top 50 companies on average. But in recent years, we have seen Nifty PE go above 30, sometimes touching 37, 38. What does that mean? It means the market is pricing in perfection. Every company must grow fast. No slowdowns, no bad quarters, no global shocks. Does that sound like the real world to you? And it gets worse at the individual stock level. Some new age tech companies, loss making companies, were trading at PE of 200, 300, sometimes with no PE at all because they had no earnings. People were still buying because FOMO is a powerful drug. High PE is not a crime. Sometimes a high PE is justified if the company is growing earnings very fast. But most retail investors never stop to check. So, how do you use PE without overcomplicating it? Three simple rules. One, compare PE to the company's own history. If a stock usually trades at PE 20 and today it is at 40, something has changed. Either the company got much better or the market got too excited. Find out which. Compare PE within the same sector. A PE of 30 might be cheap for an FMCG company, but expensive for a PSU bank. Context matters. 3. Never use PE alone. Pair it with earnings growth. A stock with PE of 40 but 40% annual earnings growth might be a fair value. A stock with a PE of 40 and 5% growth, that is a real flag. You can check PE for any Indian stock in 10 seconds. Go to screener.in, type the company name. It is right there on the front page. Free. No account needed. Here is the truth about Indian retail investors right now. We have some demat accounts than ever before. More SIMs than ever before. More financial apps than ever before. But more money in the market doesn't mean more knowledge in the market. PE ratio will not make you rich overnight, but it will stop you from making the kind of mistakes that takes years to recover from. Know what you are paying for. This is the first rule of investing. Next week, we'll talk about how to read a balance sheet in 3 minutes. No MBA required. Subscribe if you want finance explained simply once in a week, no noise. Thank you.